On December 19, 2003, a compliance officer at Bank of America in New York examined a document that had been faxed from Italy. It was a letter on Bank of America letterhead, purporting to confirm that a Parmalat subsidiary named Bonlat Financing Corporation held approximately $3.95 billion in cash and marketable securities at the bank's branch in Grand Cayman. The officer checked the account. The signature did not match any authorized signatory. The account number did not correspond to any account. The funds did not exist. Within 4 days, Parmalat Finanziaria S.p.A., the 8th largest industrial group in Italy, filed for protection under Italy's emergency insolvency provision, Decree 347, in what remains the largest corporate bankruptcy in European history. The question this episode answers is not why a letter was forged. The question is structural. How does a publicly traded company with $1.8 billion in bonds outstanding to American investors sustain, for more than a decade, the appearance of cash that was never there? And how was the forgery of a single bank confirmation the load-bearing element of an entire financial architecture? To understand what Bonlat was, you have to first understand what it was supposed to be, and the gap between those two things is the entire case. The mechanism at the center of Parmalat is not a single instrument. It is a layered structure built on 3 components: offshore special purpose entities, fabricated intercompany receivables, and the falsified confirmation of cash. The cash confirmation is where the structure terminates, and it is where the structure was most vulnerable. So we begin there, with the legitimate function it was designed to imitate. A bank confirmation is one of the oldest tools in auditing. When an auditor examines a company's financial statements, the company asserts that it holds certain amounts of cash on deposit. The auditor does not take that assertion on faith. The auditor sends a confirmation request independently to the bank that holds the deposit. The bank responds directly to the auditor, stating the balance. This is third-party verification. It is the single most reliable form of audit evidence available because it does not originate with the entity being audited. The cash either exists at the bank or it does not, and the bank has no incentive to lie about it. The entire reliability of the cash confirmation depends on one assumption, that the response comes from the bank through a channel the company cannot control. The SEC's complaint, filed in the United States District Court for the Southern District of New York in 2003 and amended thereafter, establishes what Parmalat did to this mechanism. According to the SEC's enforcement record, Parmalat did not obtain a genuine confirmation. It manufactured one. The record describes a forged document on Bank of America letterhead, confirming a balance of nearly €4 billion that was created to deceive the auditors. The confirmation channel, which is supposed to be outside the company's control, was brought inside it. Now, why did this confirmation need to exist at all? To answer that, we have to look at the receivables. Parmalat was, on its surface, a dairy and food conglomerate. It sold milk, juice, and related products globally. A company of that nature generates accounts receivable in the ordinary course. When you sell product on credit, the amount owed to you is an asset on your balance sheet. The SEC's complaint establishes that Parmalat systematically inflated these assets. It recorded fictitious sales. It recorded receivables from customers that did not owe the amounts stated or did not exist. The record describes, among other devices, the double billing of customers, where the same sale was recorded as a receivable more than once. But fictitious receivables create a problem. A receivable is supposed to convert to cash. The customer pays. If the receivables are fake, they never convert. Over time, a growing gap opens between the assets the company claims and the cash it actually collects. The fictitious receivables age. They become conspicuous. An auditor examining a receivable that has sat uncollected for years begins to ask why. The solution, structurally, was to make the fictitious assets appear to convert into something that could not be aged in the same way. Cash. If a fake receivable could be made to look as though it had been collected and the proceeds parked as cash in a bank account, the aging problem disappeared. Cash does not age. Cash is the cleanest asset on the balance sheet. A receivable invites scrutiny. A confirmed bank balance closes the inquiry. This is the function Bonlat served. Bonlat Financing Corporation was a wholly owned Parmalat subsidiary incorporated in the Cayman Islands. According to the SEC's complaint, Bonlat became the repository for a large portion of the group's fabricated assets. The fictitious receivables and the fictitious liquidity were concentrated in this offshore entity, where they could be supported by documents that the group itself controlled. And the document that supported the largest single fiction, the nearly €4 billion in claimed cash, was the forged Bank of America confirmation. So the legitimate mechanism, third-party cash confirmation, was inverted. Instead of being the verification that exposed the fiction, it became the instrument that sustained it. The forged letter did not just hide the absence of cash. It converted a decade of accumulated fraud into an asset that appeared, on paper, to be the safest thing a company can hold. That is the mechanism. Now we build the architecture around it. The Parmalat Group was not a simple parent-subsidiary structure. The SEC's filings and the subsequent insolvency administration conducted under the extraordinary administrator appointed by the Italian government established a group of more than 200 entities spread across dozens of jurisdictions. Many of these were located in offshore financial centers. The complexity was not incidental, it was functional. Each layer of the structure created distance between the operating reality in Italy and the financial representations made to investors and auditors. Let us build it in steps, the way the record establishes it. Step 1. The operating companies in Italy and elsewhere generated real but insufficient cash flow. The business existed. The milk was real. But the SEC's complaint establishes that the company's reported financial condition diverged sharply from its actual condition over a period the record traces back to at least the late 1990s. The reported profitability and the reported cash position were materially overstated. Step 2. To bridge the gap between reported and actual, the group recorded fictitious revenue and the corresponding fictitious receivables. According to the SEC, these were booked in part through offshore subsidiaries, including entities in the Cayman Islands and elsewhere, where the operational scrutiny was lowest. Step 3. The group needed to fund itself. A company that reports billions in cash it does not have still needs real money to operate, to pay real suppliers, and to service real debt. Parmalat raised this money in the capital markets. The SEC's complaint establishes that between 1997 and 2003, Parmalat-related entities raised more than $5 billion from investors through bond offerings and private placements, including offerings marketed to investors in the United States. A substantial portion of this debt was issued through entities that placed the obligations with American institutional buyers. This is the crucial structural point. The fraud was not self-contained. It required continuous external financing. The fictitious assets on the balance sheet did not generate cash, so the company had to keep borrowing to cover the shortfall between the cash it claimed to have and the cash it actually needed. And to keep borrowing, it had to maintain the appearance of a healthy balance sheet. And to maintain that appearance, it had to confirm the cash. The forged Bank of America letter and the bond issuance were two ends of the same machine. The forgery sustained the credit rating that made the bonds saleable. The bonds provided the real cash that the forged balance sheet pretended already existed. Step 4. The proceeds of the borrowing and the fictitious assets were concentrated in Bonlat. The SEC's complaint describes Bonlat as the entity where the fabricated liquidity was held. By 2002 and 2003, the claimed cash and securities at Bonlat had grown to the nearly €4 billion that the forged letter confirmed. The record establishes that this concentration served a purpose. It localized the largest fiction in a single offshore entity, audited under arrangements distinct from the group's primary auditor. Here, we need to address the audit structure, because it is part of the architecture, not separate from it. Parmalat's group financial statements were audited by Grant Thornton's Italian affiliate and subsequently by Deloitte's Italian affiliate under rotation rules that Italian law imposed. When the primary group audit rotated to Deloitte, the SEC's complaint establishes that Bonlat remained audited by the Grant Thornton affiliate. The effect of this division was structural. The entity holding the single largest fictitious asset continued to be examined by an auditor, separate from the one signing off on the consolidated group accounts. The consolidation relied on the Bonlat figures. The Bonlat figures relied on the forged confirmation. Now, bring the title's instrument into the picture. The equity forward contract. Parmalat used derivative and structured finance arrangements as part of the concealment, and the equity forward is illustrative of the technique. An equity forward contract is, legitimately, an agreement to buy or sell shares at a set price on a future date. It is a hedging and financing tool. In the Parmalat structure, the record describes the use of such arrangements to disguise debt as equity or to mask the true nature of obligations. A financing that was, in economic substance, borrowed money could be structured to appear as something else on the balance sheet. The forward contract allowed an obligation to be presented in a form that did not register as the debt it actually was. This matters because it compounds the receivables fiction. On one side of the balance sheet, fictitious assets inflated what the company appeared to own. On the other side, structured arrangements understated or disguised what the company actually owed. The gap between the two was enormous. When the extraordinary administrator later reconstructed the group's accounts, the difference between reported and actual was measured in the billions. The SEC's complaint characterized the overstatement of assets at approximately several billion euros, and the total financial misstatement, once the administration completed its work, was substantially larger than the figure on the forged letter alone. So the org chart, drawn from memory, looks like this. At the center, Bonlat Financiaria, the listed parent in Italy. Beneath it, the real operating dairy businesses. Alongside them, a web of offshore financing entities that issued the bonds. And at a critical node, Bonlat, in the Cayman Islands, holding the concentrated fictitious cash, supported by a forged confirmation from a bank that had no such account. Money flowed in from real investors. Money flowed out to real operations and real debt service. And the difference, the structural deficit, was papered over by assets that existed only on confirmation documents the company itself had manufactured. The entire structure had a single point of catastrophic dependence. If anyone independently verified the 4 billion euros at Bonlat through the actual bank, the structure ended. Everything depended on the confirmation channel staying compromised. Which brings us to the question of the gatekeepers. How does a fiction of this scale persist for years across two major audit firms, multiple rating agencies, and the analysts of every major investment bank that underwrote the bonds? The first answer concerns the nature of confirmation fraud itself. A forged bank confirmation is among the most difficult frauds for an auditor to detect, precisely because the confirmation is the control that auditing relies on. The system assumes the bank's response is genuine. When the response is forged, the auditor is looking at what appears to be the gold standard of audit evidence. The SEC's later enforcement actions in the broader Parmalat matter addressed exactly this vulnerability. The record establishes that the confirmation requests and responses did not always travel through the independent channel they were supposed to. Where a company can interpose itself between the auditor and the bank, the verification collapses. What would have had to be true for earlier detection? The auditor would have had to send the confirmation request directly to Bank of America through an address and channel the company did not control and receive the response directly back without the document passing through Parmalat's hands. The record indicates the integrity of that channel was compromised. Once compromised, the auditor was not verifying with the bank. The auditor was verifying with the company, which had every reason to confirm its own fiction. The second answer concerns the structure of the audit itself. Recall the division. Bonlat remained with the Grant Thornton affiliate, while the group rotated to Deloitte. The SEC's complaint and the subsequent litigation address the consequences. The consolidated audit relied on figures it did not itself fully verify, because the largest single asset sat in an entity audited separately. The rotation rule, designed to enhance auditor independence, produced in this case a seam in the verification chain. The largest fiction lived precisely at that seam. The third answer concerns the rating agencies and the analysts. Parmalat's bonds carried investment-grade ratings for much of the relevant period. The agencies and the underwriters relied on the audited financial statements. They relied on the reported cash. A company reporting nearly 4 billion euros in cash and securities does not, on its face, present as a credit risk. The structural insight here is that ratings and credit analysis are downstream of the audited financials. They do not independently verify cash. They take the audited number and analyze it. If the audited number is false because the underlying confirmation is forged, the entire downstream apparatus inherits the falsehood. Every layer of analysis was, in effect, analyzing a document. But there is a subtler point in the detection failure, and the record supports it. The company carried both enormous reported cash and enormous reported debt at the same time. By 2003, Parmalat was reporting billions in liquidity while simultaneously borrowing heavily and, at moments, struggling to make payments. This combination is, structurally, a warning sign. A company sitting on 4 billion euros in cash does not need to borrow at high rates. It does not need to roll over short-term obligations under pressure. The coexistence of large reported cash and persistent heavy borrowing is internally inconsistent. The question of why a cash-rich company kept borrowing was the question that, when finally asked seriously, began to pull the structure apart. For years, that question was not pressed to its conclusion. Part of the explanation is that the cash was confirmed. The auditor's confirmation closed the inquiry that an analyst's skepticism might otherwise have opened. This is the recurring structural feature of confirmation fraud. The forged confirmation does not merely state a false fact. It preempts the investigation that would have revealed the false fact. It answers the question before it is fully asked. There is a final element of the detection failure that the record establishes, and it concerns the warning that did surface. In late 2003, market attention turned to a particular Parmalat investment. The company had reported a large holding in a fund, and questions arose about the liquidity and the existence of that investment. According to the public record, this episode, concerning the company's ability to redeem or account for a substantial fund holding, raised the broader question of whether Parmalat's reported liquidity was real. Once the market began to doubt one liquidity claim, the doubt generalized. If this claimed asset was questionable, what about the others? What about the $4 billion at Bonlat? That generalization of doubt is what triggered the unraveling. The sequence, as the public record establishes it, compressed into a matter of weeks at the end of 2003. In November 2003, scrutiny intensified over Parmalat's reported liquidity, including its investments and its ability to meet obligations. The company's reported cash position was inconsistent with its borrowing behavior, and the market began to press the inconsistency. The auditors and the company moved to verify the largest single claimed asset, the funds at Bonlat purportedly held at Bank of America. The verification meant going to the actual bank through the genuine channel rather than relying on documents in the company's possession. This is the step that the forged confirmation existed to forestall. The record establishes that in December 2003, Bank of America was asked to confirm the existence of the account and the balance. On December 19, 2003, Bank of America responded. The bank stated, in substance, that the document purporting to confirm nearly €4 billion at its Grand Cayman branch was not authentic. There was no such account. There were no such funds. The signature did not belong to any authorized officer. The single largest asset on the consolidated balance sheet did not exist. Once that fact was established through the genuine channel, the structure had no remaining support. The fictitious receivables had been converted, on paper, into this confirmed cash. With the cash exposed as fictional, the receivables behind it stood revealed as fictional. The disguised debt remained real. The gap between reported and actual, which the forged letter had concealed, was now open and unbridgeable. Within days, the consequences cascaded. Parmalat could not meet its obligations. The reported liquidity that would have covered its needs did not exist. On December 24, 2003, Parmalat Financiaria filed for admission to extraordinary administration under Italy's Decree 347, the emergency insolvency measure enacted that same month, which the Italian government adapted to handle a corporate failure of this magnitude. The extraordinary administrator was appointed to take control of the group and begin the reconstruction of its true financial position. The SEC moved in parallel on the United States front. The Commission had filed its enforcement action in the Southern District of New York, charging that Parmalat had engaged in one of the largest financial frauds in history, and that it had done so in part through securities sold to United States investors. The SEC's complaint established the core mechanism for the public record: the fabricated assets, the concealment of debt, the role of offshore entities, including Bonlat, and the forged Bank of America confirmation. Parmalat, through its new administration, ultimately settled with the SEC. The settlement, entered as a consent judgment, required the reorganized company to adopt extensive remedial governance and reporting measures. The Commission's order documented the structure of the fraud as a matter of public record. The reconstruction of the accounts conducted under the extraordinary administration established the scale. The reported financial condition of the group bore little relation to its actual condition. Assets that had been carried on the books for years did not exist. The total debt, once the disguising structures were unwound, was far larger than the company had reported. The figure on the forged Bank of America letter, the nearly 4 billion euros, was the most concentrated single fiction, but it was the visible peak of a much larger accumulated misstatement built up over years through fictitious revenue, double-billed receivables, and structured arrangements that hid borrowing. The unravelling, then, was not gradual. The fraud had a single load-bearing element, and when that element was tested through the genuine channel, the collapse was immediate. This is characteristic of confirmation fraud. The structure can stand for years on a forged document because the document is precisely the thing everyone is supposed to be able to trust. But it has no margin. The moment the genuine confirmation channel is used, there is no intermediate state. The cash either exists or it does not. On December 19, 2003, the genuine channel was used, and the answer was that it did not. What does the Parmalat case establish as a structural matter about the mechanism? First, it establishes the precise vulnerability of the bank confirmation as an audit control. The confirmation is reliable only to the extent that the channel between auditor and bank is independent of the entity being audited. When a company can interpose itself in that channel, the most trusted form of audit evidence becomes the most dangerous, because it carries the authority of third-party verification while in fact originating with the party being verified. The Parmalat fraud was at its terminal point, a fraud against this single control. In the years following, audit practice moved toward electronic confirmation systems designed to remove the audited company from the confirmation channel entirely, sending requests and receiving responses through independent platforms that the client cannot intercept. The structural lesson the profession drew was not that confirmations are unreliable, it was that the channel must be secured against the one party with the motive to forge it. Second, the case establishes the function of offshore concentration in fraud architecture. Bonlat existed to localize the largest fiction in a jurisdiction and an audit arrangement separate from the consolidated group. The seam between the group auditor and the subsidiary auditor was not a coincidental weakness. It was the location chosen for the load-bearing fiction. Where verification responsibility is divided, fraud migrates to the division. Third, the case establishes the internal inconsistency that confirmation fraud must always carry but can long conceal. A company cannot simultaneously hold vast confirmed cash and borrow heavily under pressure without the two facts contradicting each other. That contradiction was present in Parmalat's filings for years. It was visible. It was not acted upon because the cash was confirmed, and the confirmation preempted the question. The forged document did not only assert a false balance, it suppressed the inquiry that the rest of the financial statements should have provoked. The Parmalat insolvency reshaped under corporate governance regulation in Italy and contributed to the broader European and international scrutiny of cross-border audit oversight and offshore financing structures. The SEC's enforcement action stands in the public record as a documentation of how fictitious assets were created, concentrated, and confirmed. The extraordinary administration recovered value where it could and pursued claims against parties connected to the structure. The finding is this: Parmalat did not collapse because it ran out of money in the ordinary sense. It collapsed because the document that asserted it had money was tested against the institution that document named, and the institution said the account did not exist. A fraud of more than a decade, built across 200 entities and several billion euros, terminated in a single fax, a single signature that matched nothing, and a single account that was never opened. The architecture was vast. The point of failure was one letter.